Hi, and welcome to this week's market presentation. Latest news. In the latest developments, the Iranian foreign minister met with U.S. special envoys on Friday in Oman as they discussed the demands set by the United States and what Iran is willing to accept. Progress appears to have been made regarding curtailing Iran's nuclear program. However, Iran has continued to keep a firm stance on the right to enrich uranium, as well as stated that it will not be agreeing to demands by the United States, that it will keep its stocks of ballistic missiles and its ranges to what the U.S. is demanding. President Trump stated that progress is being made and that the talks have proved fruitful so far. At the same time, Israeli Prime Minister Netanyahu is set to meet with President Trump this week to discuss the progress in the negotiations between the U.S. and Iran. And reports are stating that Netanyahu will push for a harder line out of the U.S. Nonetheless, the U.S. continues to bring military equipment and assets into the Gulf in what could continue to be preparations for military action against Iran. As a result, while markets eased on what is apparently some de-escalation of tensions between the two countries, tensions remain high, with significant developments and progress still to be made to really reduce the current geopolitical risks we see in the market. Over in Asia, the Liberal Party in Japan achieved a significant victory in the parliamentary elections, winning a 2/3 majority of the seats in the lower house. The newly appointed Prime Minister Takaishi is now free to implement her stimulus package that she has proposed, which would include things such as lowering the national debt, a rise in spending, as well as measures to improve domestic consumption and economic growth. The Nikkei index rose sharply by 3.9%, while the reaction from bond markets was more cautious. On the energy side of things, we could see an increase in the demand outlook if we do see signs of improved Japanese economic growth throughout this year. But at the moment, the markets and expectations remained cautious. Weather. Moving on to the weather forecast, temperatures across most of Europe, particularly southern and western Europe, are forecasted to remain above seasonal averages over the next 7 to 10 days. As we've noted before, one exception is really northern Europe and the Nordics in particular, which continue to experience well below average temperatures. Precipitation is expected to pick up across much of Europe over the next 7 to 10 days, particularly over Central and Western Europe. In the Nordics, however, we continue to see more limited precipitation being forecasted, adding to the concerns over the deficit in the hydrological balance. Over in terms of average wind speeds, we're going to see those ease down across most of Europe over the next 7 to 10 days, with really offshore wind the only area expected to see improved wind speeds for wind power generation. Macroeconomics. The latest PMI figures for various economies were released for the month of January. For the euro area, we saw a slight uptick in the manufacturing PMI with a slight contraction in the services PMI. Overall, the European economy continues to show signs of growth, even if it's just limited. Over in the US, we've seen a further increase in the manufacturing sector PMI, while the service industry has remained more stable. Most noticeably, we do see a noticeable decrease in the PMIs out of China, with both the manufacturing and service sectors PMI decreasing by almost a whole point. Crude oil and LPG. Moving on to crude oil markets, we note the decrease in the price level as the negotiations between and discussions between the U.S. and Iran appear to be progressing, helping to decrease the current risk premium in the market. Nonetheless, markets remain tense as any deterioration of the negotiations and certainly any military action could lead to a sudden and sharp increase in prices. Besides the geopolitical tensions in the Middle East, the EIA continues to forecast an oversupplied market, with the oversupplied nature of the market potentially reaching 4 million barrels per day in the first half of 2026. Natural gas. In terms of natural gas prices eased down over the past week slightly, particularly looking at the front month, down 4.2% on the week, and the front year down 2.3% on the week. Overall, what we do note is some contango between the third and fourth quarter of the year. As we look further ahead, we'll likely see a bigger spread in order to incentivize additional injections into storage ahead of the following winter. Speaking of storage levels in Europe dipped further over the past week, down to around 37% now, and noticeably below the past 12-year average and last year's levels, with overall storage levels near the lowest levels since 2012. The situation looks worse as specific countries, particularly looking at Germany, the Netherlands, Belgium, and France, at significantly lower levels than the European average, and certainly raising concerns over the need for injections throughout this year ahead of the next year, adding some support in the forwards market. In terms of total supply and demand, we note the decrease in total demand as weather conditions have improved. Given the latest weather forecast, we could expect for total demand to ease slightly further over the next 7 to 10 days. In terms of supply has remained notably more stable, still near the bottom of the range over the past 5 years. As the ban on Russian LNG contracts comes into effect, and as we look forward to the end to long-term pipeline contracts, we definitely see the decrease in the dependency on Russia for the European gas supply mix. But nonetheless, we still see significant or noticeable flows of Russian LNG, around 5% of total European supply, and also through Turkstream, which is feeding countries in Eastern and Southern Europe in particular, such as in the Balkans, with another 5% coming from there. On the other hand, as Europe has moved away from Russian pipeline flows, it has increased its dependence on LNG, and in particularly its dependence on US LNG, which now accounts for around 27% of the EU gas supply mix and a majority of LNG imports into Europe. Overall, in terms of total share, Norway remains the largest region of origin of European gas, but it is closely followed by the US due to those LNG imports. Russia at the moment remains in third place at just over 12% of total supply. In terms of EU LNG supply per region, we see again the US dominating this share with its total share above 55%, but nonetheless we still see substantial flows out of Russia. And as the European Union bans on these LNG supplies pick up throughout this year, we'll likely see the increase in demand for US LNG in particular increase further. And it could also cause additional volatility in the market, as we just saw at the end of January when winter storms reduced US LNG exports, and given the dependency of the European Union on US supplies, could increase the volatility during those times. Look at the overall supply mix a little more closely there. We see overall Norwegian and LNG sendouts remaining relatively stable on the LNG side of things at the top of the range over the past 5 years, where flows from Norway remain more in line with the past 5-year average. Overall, investment funds have continued to turn more bullish over the last few weeks, with a noticeable reduction in the number of short positions in the market. Coal. Moving on to coal markets next, we know limited movement across indices for the forward year. In Europe, certainly the decrease in gas prices and the decrease, particularly as we'll see later in European allowance carbon pricing, were certainly leading to less demand for coal-fired power generation. Could be leading to some additional or decrease in any gas to coal switching, reducing demand for new arrivals into Europe. Over in Asia, more attention is being played on the status and future status of Indonesian exports, which are expected to contract this year as the government prioritizes domestic consumption and price stability domestically. EU and UK emission allowances. European carbon allowances have continued their decreasing trend over the past week. On the European side of things, prices have moved in a bearish direction over the last few weeks now, decreasing by around 3% for December 26 product week over week. The decrease in the UK market more noticeable, with a decrease of around 8% over the past week. Overall, emissions from the power sector in Europe have remained in line with the past 5-year average and have been decreasing on the back of the milder weather conditions. Looking at investment fund positions, we see here the decrease in the level of long positions in the market. This is primarily as a result of reports that the European Union is discussing changes to the current European emissions trading system, with potentially a slower free allocation phase out, and also looking at potentially lowering ETS targets in order to boost industrial competitiveness, as it faces increased trade barriers with the US and increasing competition with Chinese manufacturers. And so it appears that the European Union is moving towards trying to balance the need to reduce emissions to fight climate change, while at the same time maintaining an increase in the competitiveness of European industry. As a result, this uncertainty and the prospect of more lax emission targets and a slower phase out of those free emissions, leading to a decrease in the bullish sentiment in the market, and as market participants cover their positions as well. Electricity. Lastly, when looking at electricity prices have decreased over the past week on the back of the ease in gas prices, and in particular the decrease in carbon allowance prices. Looking at total demand and residual load here, we note the decrease in total demand as a result of the favorable weather conditions, but nonetheless, total grid demand so far this year has remained above last year's levels and above the past 5-year average, adding some additional pressure to electricity prices across Europe. In terms of the European supply mix, we're starting to note an uptick in French nuclear power generation as some reactors begin ramping up output throughout this week. Renewable generation, although seeing a slight dip over the last few days on the back of easing wind speeds across Europe, has remained near the top of the range over the past 5 years, which has in turn allowed for a slight decrease in fossil fuel generation, and certainly less pressure on fossil generation for the power mix. In terms of renewable output, we note that improvement in wind power generation over the last couple of weeks, which is now starting to ease back down. Hydro reservoir generation and solar generation remained a little more muted in terms of evolution, but nonetheless above the past 5-year average. In terms of fossil fuels, we note the decrease in fossil gas generation as total demand has eased down and as renewable output has improved during this period of time. Nonetheless, fossil gas generation remains at the top of the range over the past 5 years. Coal generation has similarly seen increases versus earlier in the year, very much driven by the ongoing evolution of total demand for electricity. However, coal generation has remained in line with what we saw last year and still below the past 5-year average. As weather conditions improve over the next week, depending on the evolution of renewable power generation, we could see further decreases in terms of fossil fuel power output. In terms of hydro reservoir levels, there are certainly growing concerns in the Nordic region as the current storage deficit versus the 2015-2025 average continues to be negative, with expectations that the deficit will increase further in the coming weeks, falling to the lowest levels since July of 2018, adding upward pressure on the Nordic power prices, but also raising some concerns over particularly Norwegian electricity exports to neighboring countries. Lastly, looking at the guarantees of origin, we note the uptick in pricing. This could certainly be some advantageous purchases, given that guarantees of origin over the previous few weeks had decreased to near all-time lows. As a result, we could be seeing some additional buying activity on the back of those lower prices. Even with the uptick that we've seen over the last couple of weeks with a bullish price evolution for the 2027 and 28 production years, we're still looking at lower prices than we've seen certainly over the last couple of years. That covers this market presentation. Thank you for joining.